Let's now look at illustration number 2. Entity S enters into a 100 crore notional amount, 5-year pay variable and receive fixed interest rate swap with the counterparty C. In the previous example, it was actually paying fixed and receiving variable. In this question, it is paying variable and receiving fixed. The variable rate of the variable leg of the swap is reset on a quarterly basis to 3-month SOFR. The fixed interest payments under the swap are calculated as 10% of the swap's notional amount, i.e., 10 crores per annum. All right, so if you actually plot it in the diagram, it's exactly going to be the opposite of the previous question. Let us say we have entity S and we have entity C. S is basically going to this time pay variable. It's going to pay variable which is actually at the rate of SOFR, which is secured overnight financing rate, and it will basically receive fixed rate. It's going to receive 10 percentage per annum on a notional of 100 crores, and the term is going to be 5 years. All right, the term is going to be 5 years. All right, let's continue reading the question. Entity S prepays its obligation under the variable leg of the swap at inception at the current market rates. Say that the amount is 36 crores. Just like in the previous question, S had actually prepaid its fixed rate obligation. S had prepaid its fixed rate obligation and the present value was calculated as 45 crores. In this illustration, what the question is stating is entity S is going to prepay its obligation under the variable rate. All right, whatever is the variable rate based on the current market term structure, S is basically prepaying its obligation at the rate of rupees 36 crores. All right, they've basically calculated the present value of the interest that S will actually have to pay to C, and that is determined to be equal to 36 crores. Now, how this 36 crores has been arrived at is slightly not necessary, so I'm actually not getting into the details. All right, but this 36 crores is an upfront payment that S is actually making to C as a result of entering into the swap. This is the initial investment that S is actually making in this interest rate swap. Entity S, it basically retains, entity S retains the right to receive fixed interest rate payments of 10 percentage on 100 crores every year. All right, so entity S basically continues to have the right to receive 10 percentage every year. The question is analyze whether this is a derivative contract or is not a derivative contract given that there is initial investment. All right, we have to see whether this initial investment is low or is not low and accordingly determine whether there is a derivative contract or not. Now, to determine whether the initial investment is low, I had basically earlier mentioned that we will be calculating the initial cash flow under the derivative contract. What is the initial cash flow under the derivative contract? Divide that by the cash flow for a similar position under the spot market. All right, cash flow under spot market, and we are basically going to calculate this percentage. If this percentage is low, then we are going to actually say that the initial investment is low and hence the contract will be a derivative contract. All right. Now we know that the initial cash outflow under the derivative contract is actually equal to rupees 36 crores because the question has actually already provided this information. All right, 36 crores is the initial outflow that we are having under the derivative contract. Now we have to actually see what is the cash flow that S Limited would actually have to undertake for a similar position in the spot market. All right, so the first step is to find out what is a similar position in the spot market. All right, now if you think of it, S Limited under the swap contract is having a right to receive 10 percentage from C Limited. S Limited is having a right to receive 10 percentage every year for the next 5 years from C Limited. A comparable position to this would be an investment in a fixed rate bond. The comparable position would be investment in a bond where the coupon rate is fixed at 10 percentage, because if S Limited invests in a bond where the coupon rate is 10 percentage, then S Limited would actually receive the 10 percentage every year, similar to this derivative contract. So a comparable position to this interest rate swap would be an investment in a fixed rate bond. All right, so the comparable position, just like in the previous question, the comparable position was an investment in a floating rate bond. Over here, the comparable position is an investment in a fixed rate bond, where the coupon rate is fixed at 10 percentage. All right, so the fixed rate bond where the coupon is fixed at 10 percentage. Now, for this investment, the outflow that would be required for a spot market would obviously be close to the face value. It will not necessarily always be equal to the face value, but it will be closer to the face value of rupees 100 crores. All right, so I'm actually considering the cash outflow to be equal to 100 crores. To purchase a fixed rate bond, typically you would actually obviously have to invest approximately 100 crores. A bond always need not trade at par, it can trade at a discount or at a premium, but where I'm considering that the bond is trading at par, therefore the initial investment is under the derivative contract is only 36 percentage of the cash outflow that we would have incurred under the spot market. I would have incurred an outflow of rupees 100 crores to purchase a fixed rate bond, which would give me 10% coupon every year. But for a similar contract in the derivatives market, I only actually incurred 36 percentage of the outflow. Therefore, this contract will be accounted for as a derivative contract. This is exactly not how you are actually supposed to think. All right. We said that the comparable position over here to receiving 10 percentage every year is an investment in a fixed rate bond. All right. If you actually think there is also another comparable position, and the comparable position is basically purchasing an annuity. If you think of it, S Limited over here has a right to receive 10 percentage every year. It has a right to receive 10 percentage every year, which means it has a right to receive 10 crores every year. So don't you think it's actually like an annuity cash flow of 10 crores for the next 5 years? So the comparable position would also be not only an investment in a fixed rate bond, but the comparable position would also be a purchase of an annuity. The comparable position, there is a second comparable position, which is purchase of an annuity. All right. So comparable position 2 is basically purchase of an annuity, where S Limited purchase of an annuity where S Limited is basically going to receive 10 crores every year for the next 5 years. All right, where it's going to receive a fixed annuity of 10 crores for the next five every year for the next 5 years. All right, so the comparable position is basically purchasing an annuity as well. So what we actually now have to do is we have to compare the cash flow or cash outflow under the derivative contract. What is the initial investment under the derivative contract divided by the cash flow that we would actually have if we were entering into an annuity, if we were purchasing an annuity, what would be the cash outflow that entity S Limited would have undertaken? All right, we have to actually compare the initial investment under derivative contract, or the cash flow under derivative contract divided by the cash flow under the spot market. Now, under the spot market, we have identified that there is a second comparable transaction or a comparable position, which is purchase of an annuity. Now, obviously, the question is not given what is the price or what is the cash flow that we would have to purchase an annuity. What is the cash flow that we would actually undertake to purchase an annuity? If you think of it, what typically happens in an annuity is you go to the insurance company and you tell the insurance company that you want a fixed cash flow of 10 crores every year for the next 5 years. What the insurance company would do is it would collect a lump sum amount from you upfront. It would collect a lump sum amount from you upfront itself, and then it will pay 10 crores every year for the next 5 years. Now, what would that lump sum amount be is what we have to plot it in the denominator. The numerator is given as 36 crores. The denominator is basically the lump sum amount that S Limited would actually have to pay to the insurance company for purchase of annuity. If you think of it, the lump sum amount is going to be nothing but present value of the 10 crores for the next 5 years. It's basically the present value of 10 crores for the next 5 years. It'll be, let's say, approximately rupees 45 crores. We have 10 crores for the next 5 years, that is 50 crores. If you discount it, let us say it approximately comes down to 45 crores. All right, so 36 divided by 45 is going to be about 80 percentage. All right, so basically, under this contract, we are actually undergoing a cash outflow, which is 80 percentage of a cash outflow that we would have undertaken for a similar position in the spot market. To purchase a similar position in the spot market, which means for me to actually receive an annuity cash flow of 10 crores every year, I would probably in the spot market pay 45 crores. Over here under this derivative contract, I paid 36 crores, which is 80 percentage of the amount that I would have paid under the spot market. Now 80 percentage is considered as a significant amount. All right, the 90% threshold is as per US GAAP. IFRS or Ind AS does not have any such threshold, and we are actually going to consider 80 percentage also as a significant number. All right, we are going to consider 80 percentage of initial investment also as a significant number, and therefore since this is significant, we are actually not going to account for this contract as a derivative contract. We are not going to account the interest rate swap as a derivative contract. All right, remember, although I got 80 percentage, this 80 percentage is also an approximation because the present value of 10 crores for the next 5 years may not be 45. It might actually be, let's say, 40 crores or maybe some other amount as well. All right, but 80 percentage, we are going to consider it as significant, and therefore we are not going to account for this contract as a derivative contract. Then the question is, how are we going to actually account for it? We will account for it as if we purchased an annuity. We will account for it as if we purchased an annuity, and the journal entry for that will basically be investment in annuity. All right, we have basically purchased an annuity, so it will be investment in annuity debit of 36 crores, and we credit cash of 36 crores. All right, it fails the definition of having a low initial investment. Therefore, we are not going to account for it as a derivative asset. We will be accounting for it as an investment in annuity and not as a derivative asset. Remember, the 90% threshold that I mentioned is a US GAAP rule, but over here, we are not going to consider the threshold as 90 percentage. 80 percentage is also a significant amount, and we are actually going to consider this as a not low investment. All right, this fails the condition of having a low initial investment. And obviously, the 80 percentage is calculated based on my own cooked up numbers, because over here, 45 crores, I did not have any scientific calculation. I just randomly plotted it as 45 crores. So the percentage could actually be higher as well. All right, so now this contract is not going to be accounted as derivative, and instead it will be accounted for as if we purchased an annuity itself from the market. All right, so over here in this illustration, there were two comparable positions. One position was an investment in a fixed rate bond. If we use that as a comparable position, the percentage was coming to 36 percentage, which we would have considered as not significant, and we would have said that it is a derivative contract. However, there was a second comparable position, which is purchasing an annuity, because over here S Limited has a right to receive 10 crores every year, and that the comparable position for this would basically be purchasing an annuity of 10 crores every year, purchasing an annuity wherein you receive 10 crores every year for the next 5 years, and that would have an outflow of, let us say, approximately 45 crores, and hence the initial investment is going to be significant. Therefore, this cannot be accounted for as a derivative contract. All right, so let us actually read the solution. In effect, this contract results in an initial net investment of 36 crores, which yields a cash inflow of 10 crores every year for the next 5 years. By discharging the obligation to pay variable interest rates, entity S in effect has provided a loan to counterparty C. It is as if I've provided a loan to counterparty C. Therefore, all else being equal, the initial investment in the contract should equal that of other financial instruments that consist of fixed annuities. All right, we are going to look at it as if it is a fixed annuity. Thus, the initial net investment in the pay variable receive fixed interest rate swap is equal to the investment required in a non-derivative contract. What it is stating is, ideally, for you to purchase a similar position in the spot market, for you to purchase a similar position in the spot market, in the non-derivative market, basically means spot market, you would actually have an outflow of 36 crores only. All right, it is stating the initial net investment in the derivative contract, in the interest rate swap, would be equal to the investment that you require in the spot market. To purchase a fixed annuity, you would have actually had an outflow of 36 crores. Under this interest rate swap, also you have an outflow of 36 crores. Therefore, you are actually breaching the condition of having low or nil net initial investment. All right, the net initial investment is basically 100 100% in this case. All right, it's saying that it would be ideally equal under both the circumstances, and then thus the percentage would actually be 100%. In the numbers that I took, I got a percentage of 80, but the answer is stating that it would ideally be equal to 100%. The cash outflow under the swap would actually be equal to the cash outflow for you to purchase a fixed annuity of 10 crores for the next 5 years. For this reason, the instrument fails the condition of no initial investment or initial net investment that is smaller, and therefore this contract is not accounted for as a derivative contract. This contract will not be accounted for as a derivative contract. Instead, it will be accounted for as a purchase of annuity. All right, with that, we are done with illustration number 2 as well.